The economic environment we're in right now is the result of years, decades, of decisions, policy responses, and global shifts converging. And what many investors fail to understand is that economies move in cycles, and every cycle, no matter how long or how different it feels, eventually matures and transitions. Where we are now is unmistakably late cycle. The warning signs are subtle for those who haven't studied economic history, but they're loud and clear for anyone paying close attention. Over the past 15 years, we experienced an unprecedented period of economic expansion fueled by easy money. After the 2008 financial crisis, central banks flooded the system with liquidity, dropped interest rates to zero or near zero, and began the era of quantitative easing. That environment created a sense of security, false in many ways, that low rates and central bank support would always be there. It led to over-leverage, speculation, and a widespread underestimation of risk. The problem is, those conditions were never sustainable. They were temporary solutions to deep structural imbalances. The pandemic further accelerated this dynamic. Massive fiscal stimulus was injected globally to avoid economic collapse, and while that was necessary to some extent, it added more fuel to a system already under strain. Debt levels soared. Asset prices inflated well beyond their fundamentals. And consumers, businesses, and governments all became dependent on a level of monetary and fiscal support that simply cannot continue indefinitely. Now the pendulum is swinging the other way. Inflation, once dismissed as transitory, is proving far more persistent and sticky than policymakers anticipated. The tools used to fight inflation are the same ones that constrain growth: higher interest rates, tighter credit, reduced liquidity. These tools are now in motion, and we're beginning to see the early consequences. Economic growth is slowing, corporate margins are tightening, consumer demand is weakening, credit stress is emerging, especially in more leveraged sectors. This is what happens in the later stages of a debt cycle. The cost of money goes up, and those who relied too heavily on cheap capital find themselves exposed. There's a psychological shift that happens in times like this. During the boom, people chase yield, ignore risk, and assume that past returns will repeat. But as the cycle matures, fear begins to replace greed. Behavior changes. Investors become more cautious. Banks tighten lending. Households pull back on spending. It's a self-reinforcing process that gradually cools the economy, and if not managed carefully, can tip into contraction. What makes this period particularly dangerous is that the traditional tools central banks use to stimulate the economy are far less effective when debt levels are already high. Lowering rates from 5% to 2% has a very different impact than lowering them from 1% to 0. When rates are near the floor and balance sheets are stretched, the margin for error shrinks dramatically, and that's where we are now, operating with less room to maneuver and more fragility baked into the system. Another important point: market participants often think in short-term increments, quarters, maybe a year or two, but the forces driving economic cycles operate on much longer timelines. If you zoom out, you see that the current environment bears similarities to past late cycle periods: rising inflation, rising interest rates, growing fiscal deficits, elevated asset prices, and increasing political and social polarization. These factors don't play out overnight, but they eventually converge into major inflection points. One of the most common mistakes investors make is assuming that today's environment is fundamentally different, that this time is different, but the patterns are clear. Every economic expansion sows the seeds of its own reversal. Excesses build, imbalances widen, and eventually the system has to correct. That correction is not a catastrophe. It's a normal, healthy function of a cyclical system. But if you're not prepared for it, if you don't understand where we are in the cycle, you can suffer significant losses. We are not yet in crisis, but we are in transition. And transitions are when the greatest mistakes and the greatest opportunities occur. Recognizing that the economic cycle is maturing is not about panic. It's about perspective. It's about seeing the larger arc of events and positioning accordingly. The time for aggressive risk-taking has passed. Now is the time for prudence, diversification, and a reassessment of assumptions. Because in the later stages of a cycle, the rules change, and those who don't adapt usually learn the hard way. There are moments in history when multiple major forces, each significant on its own, start moving in the same direction, creating a convergence that defines an era. That's where we are right now. What we're seeing is the simultaneous rise of three powerful forces: mounting debt, intensifying geopolitical tensions, and deepening internal fragmentation within countries. These aren't isolated problems. They're interconnected symptoms of long-term structural imbalances. And when they come together, they tend to produce major inflection points in the global order. Debt, first of all, is reaching levels that are not just high, they are structurally unsustainable. Both public and private sectors have been accumulating debt for decades, but the pace has accelerated dramatically in recent years. Governments, in particular, have taken on massive obligations to deal with crises, from the financial crash to the pandemic, and the result is a global economy that's more leveraged than ever. Debt is a double-edged sword. In good times, it amplifies growth, but in times of tightening conditions, it becomes a trap. Interest payments rise, fiscal flexibility disappears, and economies become vulnerable to shocks they could once absorb. The current environment of rising interest rates is exposing just how fragile some of these structures are. It's not just about numbers on a balance sheet, it's about sustainability. At some point, servicing debt becomes more difficult than acquiring it, and that's when the cycle starts to turn. At the same time, geopolitical dynamics are shifting in a way that we haven't seen in decades. The world is no longer operating under a unipolar model. We're moving toward a multipolar system where major powers, each with their own interests, values, and systems, are competing for influence. The U.S. and China sit at the center of this shift. Their relationship is increasingly defined not by cooperation, but by strategic rivalry economically, technologically, and militarily. Trade flows are being reshaped. Alliances are being tested. Global institutions that were once seen as pillars of stability are now questioned or bypassed altogether. And beneath it all is a growing uncertainty about what the global order even looks like moving forward. Geopolitical stress also has economic consequences. It disrupts supply chains, raises the cost of doing business, and creates volatility in commodities, currencies, and capital markets. But it goes deeper than that. It undermines trust between countries, trust in rules, trust in the predictability of the system, and when that trust breaks down, capital moves more cautiously, businesses hold back, investors demand higher risk premiums. The economic machine slows, not just from market forces, but from systemic uncertainty. Then there's the internal side of the equation. Within many major economies, especially the most developed ones, we're seeing significant internal divisions. Political polarization is at levels not seen in generations. Social cohesion is weakening. Economic inequality has widened to the point where large segments of the population feel the system no longer works for them. And when people lose faith in institutions, they become more susceptible to populism, extremism, and zero-sum thinking. That translates into unpredictable policy, rising conflict within societies, and less capacity to respond to external threats. It becomes harder for governments to act decisively when their own populations are divided on fundamental values. When you step back, it becomes clear that these forces, debt, geopolitics, and internal fragmentation, are reinforcing each other. High debt levels limit the ability of governments to respond to geopolitical threats or domestic discontent with strong fiscal tools. Geopolitical rivalries force nations to prioritize defense and control over cooperation and growth. And internal fragmentation makes consensus harder, weakening governance at a time when strong, clear policy is essential. The system becomes brittle, vulnerable to even small shocks. This is not a doomsday scenario, but it is a reality check. We've entered a phase where the assumptions that held for decades are no longer safe. The idea that peace between major powers is inevitable, the assumption that institutions will always function, the belief that debt can grow forever without consequence. All of those are being challenged now, and the wise course of action is not to deny that shift, but to adapt to it. Periods like this have happened before. In the 1930s, we saw similar patterns: high debt burdens, rising populism, growing global tensions, and weakening international institutions. The outcomes weren't inevitable, but they were shaped by how people and policymakers responded. Those who recognized the convergence early had a chance to navigate it. Those who ignored it were blindsided. The same will be true this time. Seeing the convergence is the first step. Preparing for its consequences is the next. For a long time, the idea of diversification was seen as a cornerstone of risk management. The principle was simple: spread your investments across different asset classes, stocks, bonds, real estate, maybe some commodities, and you could reduce your overall risk without sacrificing too much return. That strategy worked for decades because the relationships between those assets were stable and somewhat predictable. But the environment we're entering now is fundamentally different. The same old diversification playbook that served investors in the past may no longer be sufficient or even relevant. The traditional 60/40 portfolio, 60% equities, 40% bonds, was built on the assumption that bonds would act as a hedge during equity drawdowns. And for many years, that inverse correlation worked well. When stocks fell, bonds typically rose. Central banks had the room to cut rates during downturns, which supported bond prices and provided much-needed ballast to portfolios. But we are no longer in that kind of world. We're now in an environment where inflation is structurally higher, interest rates are elevated, and both equities and bonds are facing pressure at the same time. In 2022 and 2023, we saw exactly what happens when both sides of that equation break down together. Investors who thought they were diversified suddenly realized they weren't protected at all. When inflation rises and interest rates follow, bonds lose value. And when those rate hikes start to impact corporate earnings and liquidity, equities fall too. In that kind of environment, correlations change, and with them, the entire concept of diversification must be rethought. Beyond that, the global order that underpinned decades of economic and market stability is fragmenting. The era of globalization, free flowing trade, and synchronized monetary policy is giving way to one of fragmentation, protectionism, and divergence. This introduces a new kind of risk, one that doesn't show up in traditional models. It's geopolitical, structural, and deeply systemic, and it cannot be hedged with a bond allocation alone. To navigate this kind of world, investors need to think in terms of resilience, not just return. They need to build portfolios that are robust across a wider range of scenarios, including ones that haven't occurred in recent memory. That means diversifying not just across asset classes, but across geographies, currencies, political systems, and economic regimes. A portfolio concentrated in Western markets and denominated in a single currency is inherently fragile in a multipolar world. Currencies themselves are another source of hidden risk. For years, the U.S. dollar has been the world's dominant reserve currency. That's given U.S.-based investors a powerful advantage, but also a blind spot. When you assume that your currency is stable and supreme, you don't hedge against the possibility that it might weaken. But that's precisely the kind of assumption that becomes dangerous in a world of shifting power dynamics. Countries around the world are beginning to question dollar dominance, not because there's a clear replacement, but because the system is changing. And those shifts can have real consequences for capital flows, inflation, and asset prices. Another layer to consider is that traditional financial assets are now more correlated with macroeconomic policy than ever before. Central banks, fiscal policy, and government interventions are dictating market outcomes in ways that blur the line between economics and politics. That makes the environment harder to model, harder to predict, and harder to hedge with conventional tools. Investors must think more holistically and more historically. They need to study not just the last 10 years, but the last 100. In past periods of structural change, like the 1930s, the 1970s, and even the early 2000s, those who protected themselves weren't the ones who followed conventional wisdom. They were the ones who understood that when the world changes, your investment strategy has to change with it. Holding gold during monetary debasement, holding hard assets during inflation, holding cash when liquidity dries up. These aren't radical ideas, they're timeless ones, but they've been forgotten by many because they haven't been needed. Until now, what's required moving forward is a new framework, one that prioritizes balance, adaptability, and historical awareness. You don't just want assets that perform well under one scenario. You want a mix of assets that can survive multiple potential futures. Because if the only environment in which your portfolio does well is the one we've already left behind, then you're not diversified at all. You're just exposed in ways you don't yet understand. One of the most costly assumptions investors make is that the future will behave like the recent past. This kind of thinking leads to complacency, buying overpriced assets, taking excessive risks, ignoring warning signs, all because things have worked out recently. But history teaches a very different lesson. It shows that cycles repeat, that human behavior, driven by fear, greed, pride, and denial, follows consistent patterns, and that those who fail to study those patterns are often the ones most hurt when the cycle turns. People tend to believe their time is unique. They look at technological innovation, financial engineering, or modern policy tools and convince themselves that this time is different. But if you go back through history, you see that the underlying mechanics of economic, political, and social cycles remain remarkably consistent. There are periods of strong growth, rising optimism, and expanding credit. These are followed by excesses over confidence, leverage, speculation. Then comes tightening, correction, and often some form of restructuring or reset. That pattern has repeated itself over and over again. If you look at the 1930s, for example, you'll see a period of extreme inequality, high debt, political polarization, and monetary debasement. That decade didn't just happen. It was the result of long-term imbalances that had built up during the 1920s, masked by the optimism of the boom years. When the correction came, most people weren't ready for it. They had assumed the prosperity would continue, just as many are doing today. They failed to study what came before, and as a result, they were blindsided. The same can be said for the 1970s. That period was shaped by inflation, geopolitical conflict, and a breakdown of the monetary system as the U.S. abandoned the gold standard. Again, these outcomes weren't random. They were the logical consequence of policy decisions and global dynamics that had been set in motion years earlier. Investors who were anchored to the prior decade, the post-W2 boom, were caught off guard. Those who understood the broader historical cycles were better positioned to adapt. Even in more recent times, 2008, for instance, the crisis didn't come out of nowhere. The signs were there: excessive leverage, inflated asset prices, and complex financial instruments that few truly understood. But the prevailing belief was that central banks could manage any fallout, that markets were efficient, and that housing prices never fell nationally. Those beliefs, like many before them, were based on short-term experience rather than historical understanding. Today, we're once again in a period where the patterns are rhyming: high debt levels, rising populism, deteriorating international relations, central banks with limited tools, and a growing divide between economic fundamentals and asset prices. This isn't just a collection of isolated data points. It's the setup for a larger shift. And if you look at history, you'll see similar setups have almost always led to major paradigm changes. The value of studying history isn't in predicting the exact date something will happen. It's in understanding the forces at play so you can recognize when conditions are shifting, so you're not surprised when the unsustainable becomes unstable. It helps you make better decisions, not just based on probabilities, but based on patterns that have repeated for centuries. One of the biggest risks right now is that we've gone through an unusually long period of stability. Many investors have never seen a real tightening cycle, never experienced high inflation, never lived through capital controls or currency devaluations. Their expectations are shaped by the past decade, not the past century. That narrow view can be dangerous, because when the environment changes, and it will, the rules change too. Assets that worked for years may suddenly stop working. Strategies that looked smart may start to underperform, and behaviors that were rewarded in the old environment may be punished in the new one. Without historical context, those changes feel random. With it, they make sense. Studying history doesn't make you immune to risk, but it gives you the tools to manage it better. It helps you avoid the extremes of euphoria and despair. It gives you perspective when others are panicking, or when they're blind to danger. And most importantly, it reminds you that every cycle eventually turns. Those who are prepared for that reality will be able to navigate the coming shifts. Those who aren't may find themselves, once again, blindsided